Hello and welcome. If you're a landlord here in the UK, I have a question for you. Are you absolutely certain you're not overpaying on your taxes? Well, in this guide, put together by the experts over at ProTax Accountant, we're going to break down exactly how you can legally and very efficiently reduce your rental income tax bill. Right, let's dive straight in. So, first things first, let's talk about a number. £5,000. For a lot of UK landlords, this is how much they could be overpaying in tax every single year. I mean, that's money that should be in your pocket, reinvested, saved, or used to make your properties even better. Today, we're going to show you how to keep it. You know, it's no secret that things are getting tougher out there for landlords. Even with rents being at an all-time high, so many are feeling a serious, and I mean serious, profit squeeze. We've got rising costs, we've got inflation, and of course, massive tax changes like Section 24. It's all completely changed the game for property investors. Okay, so let's really get to grips with this challenge. In this first part, we're going to break down why profits are being squeezed tighter than ever. Because honestly, once you really understand the problem, you can start putting the solutions, the ones we've got lined up for you, into action. What's really hitting landlords is this sort of perfect storm of costs. You've got Section 24, which is a huge deal. It means if you're a higher rate taxpayer, you can't deduct your full mortgage interest anymore. Instead, you get a much less generous 20% tax credit. Then, on top of that, insurance premiums have jumped by 20, even 30%. And of course, inflation is making every single repair job more expensive. And to top it all off, new rules like making tax digital just add more paperwork. It feels like you're fighting a battle on all fronts, doesn't it? So how on earth do you fight back? Well, your first and honestly, your most powerful line of defense is mastering your allowable expenses. This is the absolute foundation for every landlord out there, and it is the quickest, most direct way to start cutting that tax bill, literally today. Okay, this right here is the golden rule from HMRC. You need to remember this phrase, wholly and exclusively. For any cost to be deductible, it has to be entirely for your rental business. So let's say you buy a new laptop. If you use it 60% of the time for your properties and 40% for watching Netflix, you can only claim 60% of the cost. Simple as that. If it's for the business and only for the business, you can claim it. Now, this is a big one. This is where so many landlords get tripped up. Let's make it real. Imagine a landlord will call her Sarah from London. Her tenant's boiler goes up. If Sarah just replaces it with a similar, modern version, that's a repair. The full cost is an allowable expense, and she can deduct it from her income this year. But what if she decides to upgrade to a super fancy, top-of-the-line system that can now heat a new extension she's planning? Well, that's an improvement. It adds value, so it becomes a capital cost, not an immediate deduction. Getting this difference right is absolutely crucial. And look, here's a quick rundown of the kind of costs you should be tracking like a hawk. We're talking letting agent fees, your insurance premiums, every single penny you spend on a lick of paint between tenants. And here's a fun one. Did you know your accountant's fee for doing all this tax stuff for you is itself a tax-deductible expense? Yep. Plus, don't forget things like council tax when the property's empty. Believe me, it all adds up. All right, here's a pro tip for you, and honestly, so many people miss this. If you drive to your rental property for an inspection, or to meet a handyman, or even just to pop to B&Q for surprise, you can claim mileage. At 45 pence a mile, just a few trips a month can easily add up to hundreds of pounds in deductions over the year. It's such a simple, easy win. Okay, let's get really practical with something called replacement of domestic items relief. Imagine Tom's tenant's fridge breaks. He goes out and buys a fancy new one for 500 quid. Now, he can't claim the full 500 pounds because it's a bit of an upgrade. He can only claim what a like-for-like replacement would have cost, which in this case was 300 pounds. Then, he manages to sell the old broken fridge for scrap for 50 pounds. He has to subtract that from his claim. So his final claimable expense is 250 pounds. It's a very specific calculation, but getting it right is what saves you cash. Right, so that covers all the day-to-day costs. But listen, the biggest savings, they're often found not in what you spend, but in how you're actually set up as a business. So stay with me for this next part, because for a lot of you, this is where the game really, truly changes. This breaks it down beautifully. You've got two main paths. As an individual landlord, your rental profits just get added on top of your other income and are taxed at your personal rate. That could be up to 45%. And remember, you only get that 20% tax credit on your mortgage interest. Now look at the limited company. The profit is taxed at a flat corporation tax rate. But here's the real kicker. The company can deduct 100% of the mortgage interest as a business expense before tax is even calculated. That is a huge, huge difference. 40%. If you're a landlord earning over about 50 grand a year from all your income, this number should really grab your attention. This is the tax rate you're likely paying on your rental profits if you're a higher rate taxpayer operating as an individual. And here's the contrast, 25%. That's the corporation tax rate that a limited company pays on the exact same profits. The gap between those two numbers could mean thousands and thousands of pounds in tax savings, especially if you have a larger portfolio or big mortgage costs. Okay, let's zoom out and talk about the long game for a second. Smart tax planning isn't just about what you pay year on year. It's about your exit strategy. Thinking ahead to the day you eventually sell your property is absolutely crucial for protecting the profit you've worked so hard for. So when you sell, you're going to come face to face with capital gains tax, or CGT. Put simply, it's a tax on your profit. You take the price you sold it for, subtract what you originally paid for it, and this is really important, you also get to subtract the cost of all those capital improvements we talked about earlier. Remember Sarah's fancy boiler upgrade? That cost can now be used to lower this tax bill. Whatever is left over is your gain, and that's the bit that gets taxed. The good news is there are some really powerful and totally legal ways to slash this bill. For instance, if you ever lived in the property yourself, you can claim relief for that time. Everybody also gets a tax-free allowance each year, which for the 2024-25 tax year is £3,000. You could also transfer a share of the property to your spouse before you sell to use their allowance too. See? This is where foresight really pays off. Okay, let's bring this all together and figure out your next steps. The main thing to remember is that this is not about tax avoidance. Not at all. It's about smart, strategic financial management. Taking control of your taxes is just a fundamental part of running a profitable and sustainable rental business. So here is your action plan, nice and simple. Number 1, track everything. I don't care if it's an app, a spreadsheet, or the back of an envelope, just record every single allowable expense. Number 2, review your structure. Especially if you're a higher rate taxpayer, you need to ask yourself if operating as a limited company might make more sense now. And number 3, always plan your exit. Think about capital gains tax long before you even think about putting that property on the market. Now look, every single landlord situation is unique. The strategies we've gone over today are a fantastic starting point, but for advice that is tailored specifically to your portfolio and your goals, it is always best to speak to a professional. The experts at ProTax Accountant are ready and waiting to help you navigate all of this. You can reach them directly by phone or on WhatsApp at 07985 689912 or just send an email to info@protaxaccountant.co.uk. I really hope this guide has given you some clear, actionable ideas you can use to take control of your rental income tax. If you found it helpful, please make sure you subscribe to the Pro Tax Accountant YouTube channel. They have got tons of expert guides just like this one, all designed to help you run your property business more profitably. Thanks so much for tuning in.